Good afternoon. This is Anna Pinedo from Mayor Brown, and I'm joined this afternoon by Ashley McNeil, Managing Director and Head of Technology Equity Capital Markets with Morgan Stanley, Jeff Thomas, Senior Vice President and Head of Western U.S. Listings and Capital Markets with NASDAQ, and my partner, Brian Hirschberg, also in the New York office of Mayor Brown. And later in today's program, we'll be joined by Spenser Skates, co-founder and CEO of Amplitude, an issuer that completed a direct listing earlier, a couple of months ago. And we'll hear directly from Spenser about the company's experience with direct listing. So in terms of the agenda, we'll just go to the next slide. We are going to try and provide a little bit of an overview of the basics of a direct listing, focusing on the NASDAQ rules for direct listings, discuss a bit the investor education process, as well as the process to ensure that there's a liquid market once a company undertakes a direct listing, talk a little bit about the legal requirements and timing as compared to a traditional IPO, and then discuss the future of capital raising in conjunction with a direct listing now that the Securities and Exchange Commission has actually approved rules for that process for both the New York Stock Exchange and the NASDAQ. So just to start at the beginning in terms of what we're talking about when we're referring to a direct listing. So next slide. When we're talking about a direct listing, we're referring to a listing of a class of a company's equity securities for trading on a stock exchange without conducting an underwritten or firm commitment traditional initial public offering or a spinoff or relisting post a bankruptcy or pre-PAC, or a transfer from another stock exchange. So brand new listing as a way of developing a liquid market for the company's equity securities, after which the company becomes an SEC reporting company and has obligations to subsequently file periodic reports under the 34 Act and becomes subject to the corporate governance requirements of both the SEC and the exchange on which it's listing its shares. And as part of this process, as we'll delve into a little bit throughout the presentation, the company is required to file with the Securities and Exchange Commission a resale shelf registration statement that that is registering the resale of the stock of existing security holders so they can sell their shares into the trading market. So for those of you who may think back and recollect this direct listings or what used to be referred to as backdoor IPOs a long time ago, it's been possible for many years for companies to file a Form 10, for example, an information statement, and list their securities on a stock exchange without going through this process of filing a registration statement for selling stockholders. That's quite different from the process that was followed, for example, by Spotify, which paved the way for this direct listing approach. The SEC, in part to ensure that there's a path to Securities Act liability, required this approach of the resale registration statement in order to allow for a direct listing on an exchange. So next slide, we're going to talk about all of the various reasons or rationales why companies, their boards of directors, and large stakeholders choose or favor a direct listing over a traditional IPO of course, we'll hear directly from Spenser why it was the right approach, or why it was a compelling approach for Amplitude in particular. And of course, each of these factors is going to carry different weight for each company. Next slide. In terms of the comparison to a traditional IPO, unlike a traditional IPO, which has a lockup, traditionally a 180-day lockup, although there may be some chinks in the traditional 180-day lockup. Direct listing provides liquidity for the company's existing stockholders. Since companies are taking longer and longer to go public these days, there may be pent-up demand on the part of existing stockholders for liquidity. To date, there's been no new capital raised by companies that have pursued direct listings. There will be the requirement, as I mentioned, to have a resale registration statement declared effective in connection with a direct listing. So that effectively is going to result in a process from a documentation perspective, a diligence perspective, a cost perspective that's somewhat similar to a traditional IPO process. However, as Ashley and Jeff will tell us, with a direct listing, you don't have the same book building process to assess interest. You don't have the firm commitment from underwriters, since you don't have a syndicate, and you don't have the underwriters there with the over allotment option, the stabilizing, and the ability to ensure that there's a liquid aftermarket. Next slide. Management, in fact, plays a very limited role in determining the initial reference and opening trading price compared to the role that they might play along the way in connection with a traditional IPO. So with that, I'm going to turn things over to Ashley to really walk us through advantages and disadvantages and really the considerations that companies mull over when they're thinking about a direct listing.
Great, thanks, Anna. So look, I think direct listings are an evolution of a how to go public product, which is continuing to mature, and it's arguably no longer in its infancy phase, but it's probably in its teenage years, is how I would think about it. So the advantages are still all being sorted out and assessed by both the issuers and the buy side. I think the most obvious one for direct listings of why would someone direct list is that there is no dilution for existing shareholders as of yet. None of the direct listings as of today facilitate a way to raise capital. And as such, there is no dilution, primary capital. So as such, there is no dilution for shareholders. There's no new shares issued by the company. And that's often perceived as a really good advantage to becoming a public company without having to dilute yourself. I think other key advantages include the ability for shareholders to sell. We've only ever had one direct listing that's had a lockup. That was Palantir. The rest of the direct listings have not had lockups, which facilitates basically free trading for all non-affiliates. And affiliates, for the most part, are registered and can sell down a portion. And so it is a way for you to have a little bit more control as a shareholder of what price you sell your stock at and at what cadence you sell your stock at. The other big reason cited, and this is probably the one that's been most in the media and Twitter by my VC friends, is it is market-based pricing in theory. So the price at which the direct listing opens at and ultimately trades at is arguably a market-efficient price versus an IPO price, which oftentimes embeds what we call an IPO discount. This IPO discount is used to entice investors to participate in the book build process. It is their way of sort of feeling comfortable about the success of the IPO, and it's their way of feeling comfort in knowing that they'll get this quote unquote IPO pop. Direct listings, in theory, do not have this pop. And so as a seller and or buyer, you can choose the moment at which you're buying or selling within the market, and it eliminates this pop. I think the final thing is, oftentimes the media will cite costs as being the advantage to a direct listing. I think that when you, again, we're still in our teenage years for direct listings, so let's not jump to conclusions yet. But I do think from a cost perspective, right now we're finding that they're about equal. All things considered. However, the cost that you're paying to advisors across all fronts tends to be a little bit less because your syndicate build out is not as big, and because structurally of how the direct listing is set up and the amount of work that actually ends up falling on the company and in-house versus what ends up falling on either the underwriters or financial advisors or banks and other participants. So if we go to the next page, I think that finally, this is probably the most talked about reason is liquidity and transparency for existing shareholders. The reason why Barry McCarthy initially did Spotify was because he felt passionately about the transparency of the listing process and ensuring that everyone from the mom and pops all the way to the giant institutions had equal access and full transparency to participating in the IPO, versus what he viewed the IPO was a little bit more rigged towards the larger institutions versus the general retail population. This means, however, that it also results in existing shareholders benefiting from this liquidity process. I would keep in mind that this liquidity exercise is a transparent in an IPO or a direct listing, but the reason why a direct listing is more appealing is because that mark for securities, depending on how an individual fund markets their securities, oftentimes is that IPO or direct listing price. And again, to my earlier comment, a direct listing in theory eliminates that IPO discount. And so you're getting a closer to fundamental value for that mark as a VC. Going to the next page. So direct listings make headlines. The reason we put this in, or one of the reasons, is because oftentimes you hear the argument that an IPO is a big branding event and a direct listing doesn't have comparability. It is true that you have less control on a direct listing process, full stop. And one of those things you have less control over is the media, how the media is going to perceive the direct listing, and also the feedback that's going to be picked up by the direct listing. I would say to date, again, we're in the early phases of direct listings. To date, the media cycle has been exceptionally positive on direct listings, notwithstanding the debate between IPOs versus direct listings and the valuation phenomenon. And so therefore, we do think that as you think about direct listings and an IPO and debating between the two and viewing them as a branding event, they can be as big or as small as you want them to be. And Jeff from NASDAQ can obviously talk about the things NASDAQ does to help ensure that if you want it to be a big branding event, that it is. Going to the next page. So oftentimes the questions we get is, well, we can't raise capital in the direct listing, so does that mean I have to do a giant private placement ahead of time? And I think, again, as we go through the various phases of this product evolving, initially we would have said to you, yes, you have to do a large raise, you have to get crossover, what's deemed crossover investors that participate in the public and private market into your shareholder base to facilitate a fulsome direct listing. I think as this product becomes more well-known and as retail participation becomes more active in the product, this is less of a concern. It's still a fact pattern that's being done by direct listings, but not all direct listings have had these equity raises. That it is an important component, but it is less relevant to ensuring success of the direct listing. Now it's more a function of, do you want capital or not? And if you do want capital, but you want to do a direct listing, then you should consider a private placement ahead of time. I don't know, Jeff, did you want to talk? Because I know you see some of these private placements.
Yeah, I think one of the other practices that's evolved over the course of these direct listings is what goes into setting the reference price. And so if you look at a lot of the companies on here, they're companies that NASDAQ has actually worked with through NASDAQ Private Market. So many of the companies facilitate one-off tender offers for their shares for employees as a private company. And then a couple have actually set up ongoing continuous liquidity markets through NASDAQ Private Market to help set that reference price in advance of a direct listing. Now, I think there's some discussions right now about what's more efficient, to do it through an ongoing secondary market, who's allowed to participate, what information are you disclosing in that marketplace as opposed to the direct listing, versus doing one of these larger private raises ahead of time. But you can see there, Coinbase and Warby Parker, they didn't do a big fundraising ahead of time. In fact, Coinbase hadn't had a mark in the market since they raised capital at like $12 billion. And I think they're many, many times larger than that now. So that was an example where kind of part due to their ethos and part due to them wanting to figure out some price discovery, we worked with them to run a continuous market ahead of their direct listing, so that then you had a little bit more information going into the direct listing. I guess the other thing I'd highlight, to kind of build on some of what Ashley just said, the price discovery process that you're running here through the NASDAQ auction technology, it's really the exact same technology used to open an IPO. So today, Allbirds went public. They priced their IPO at $15 last night. And we used the exact same book building technology in conjunction with Morgan Stanley to open that stock up for trading. It opened at 21.21 and is now kind of trading in the low 20s. So, in terms of price efficiency, you really do see it on both sides. It's just a question of how you set that price. And we'll get to the topic of direct listing of the capital raise and some of the innovations there a little bit later on. Back to you, Ashley.
Great, thanks. Yeah, and I think that is also another one of the advantages of a direct listing. While the IPO and direct listing process, the book build, the opening stage is very similar, the fundamental difference for a direct listing is that your financial advisor should, if they're doing their job, be making really clear demand and supply curves for you so that you have a good understanding of which of your shareholders are selling and which of them are buying. Now, obviously, that's information that gets shared with you after you direct list because of SEC rules, which the legal team here can go into, but it's a really important way to facilitate the IR effort after the fact versus an IPO where you decide through your allocation process, through the book build process, who your shareholders are going to be. So there's a little bit of a lack of control, but a reliance on sort of information flow after the fact that becomes really important. It's also really dynamic and really fun. We turn a bunch of people into day traders who are not naturally day traders. So Jeff and I enjoy that process with direct listing. But anyway, not to belabor that point, going to the next slide. So this is always a more controversial topic of if I go public by a direct listing, will I outperform if I go public by an IPO? And the reality is, first of all, you have to step back for a second and make the assumption that markets are efficient. And by definition, both products, an IPO or a direct listing, there is going to be information asymmetry between buyers and sellers. That's just a fact of the market, of the way these are structured. And so because of that, I don't necessarily think that price performance in the long run is contingent on how you decide to go public. I do, however, think the shareholders who understand the story and the depth to which they understand the story differs depending on which way you go public. Direct listings facilitate the hardcore buy-side believers to accumulate very large positions in your name very quickly. It is a huge advantage for the large mutual funds who get very de minimis allocations in the IPO and then can never actually build out a full position in the market because either the stock becomes overvalued pretty quickly or there's just not that much liquidity. Direct listings sort of take the liquidity debate out of the equation and therefore are a very powerful tool to getting very large, particularly mutual fund complexes invested in your stock very early on. The balance to that is in a direct listing, you do not choose your partners, they choose you. And so you do not have control over, or you do not have as much control over who decides to participate in the direct listing and who doesn't, and at what price. And so therefore, when it comes time to you hit a rough patch or something, earnings aren't going to be quite what you want them to be, or something, you have to weather some storm, the loyalty factor becomes very different in an IPO versus a direct listing, which we saw in Spotify as it sort of matured. A lot of this, again, comes down to specifics around the company, what you're ultimately looking to achieve, and what the fundamental valuations are for your comparable companies in the market. I would say the studies are showing right now that direct listings are outperforming the broader market. I would be balanced to say that they're not necessarily outperforming all IPOs. For example, in tech, it's pretty binary. But I do think that it is a useful tool to going public as long as you A, know what your objectives are, and B, understand that it's still kind of going through its teenage years. So you know, we're still maturing as a product and evolving as a product. So going to the next slide, I will pass this over to you, Jeff and Anna.
Well, actually, I think I'll take it from here, Anna, unless you.
Yeah, no, please, Brian, go ahead.
Okay, thank you. So I'm going to cover stock exchange requirements. Obviously, any company that's considering a direct listing will, of course, need to demonstrate compliance with all of the listing criteria of the applicable exchange. The main one to consider in this context, in a direct listing context, is that the public float requirement is met. That's what the SEC was concerned about. That's what the exchange is focused on as part of getting amendments passed recently. So over the past few years, NASDAQ in 2019 and the New York Stock Exchange in 2018, they amended their listing requirements to more easily permit companies to list their shares upon the effectiveness of a resale registration statement that Anna mentioned up front. So this is solely for the purpose of allowing existing shareholders to sell on the exchange without undertaking, you know, an underwritten IPO. So the traditional listing rule for the New York Stock Exchange required public float, a market value of publicly held shares of at least $40 million in the context of a traditional IPO or $100 million. So the important consideration there for a direct listing is how does the exchange determine if that $100 million listing threshold was satisfied as part of the old rules. So prior to the amendments, for a direct listing, you needed to establish that by either using the lesser of an independent third-party valuation and the most recent trading price on a private placement market. So as a result, companies that didn't have recent trading prices from a trading market were precluded from proceeding with a direct listing. So the amendments were crucial to amend that $100 million threshold up to $250 million to allow a company to get an independent valuation at that threshold without relying on the trading price in a private placement market. Next slide. So critically, you know, again, how do we value where that $250 million public float comes from? So NASDAQ, as will the New York Stock Exchange, they'll consider a valuation done by an independent third-party valuer, whether that company has met that requisite threshold. Next slide. So this standard, the valuation agent needs to be independent from a affiliate perspective, so it can't own more than 5% of the securities that are to be listed. It can't have provided investment banking services over the preceding year, and it can't have an affiliate that's otherwise engaged to provide banking services to the company in connection with that listing or with other financings that are contemplated by the company. Next slide. Of course, the New York Stock Exchange has a similar rule, and you know, in addition to the public float requirement, all of the other listing requirements need to be met. I think importantly for a direct listing, because you don't have an underwriter ensuring that there are a sufficient number of minimum holders, the 400 beneficial owner limit is established. for companies that have more concentrated ownership, that may be an important thing to think about to make sure that you meet that minimum round lot holder requirement prior to proceeding with the direct listing. Of course, all the other corporate governance requirements that are typical for the exchanges also need to be complied with. Jeff, anything else that you want to add in from a NASDAQ perspective on the rules?
No, I think you did a great job covering them. I did want to suggest maybe we could skip ahead to 27 though. And before Spencer joins, hit on a really interesting topic, which is this concept of doing a direct listing with a capital raise. And so as Anna mentioned at the top, sorry, one more ahead, please. So on the next slide, you can see that it is now possible on either NASDAQ or the New York Stock Exchange, if you go ahead one more slide, to do a direct listing with a concurrent primary issuance. And so why haven't we seen one of these yet? Well, the rule that was approved by the SEC says that the direct listing must price within the range that's defined in the registration statement. Now, Ashley mentioned that one of the hallmarks and one of the things people are most passionate about around direct listings is to have a market-based price. Well, if you have a market-based price, but you have to limit it to the range that the company has set ahead of time, that kind of goes against the whole concept and the principle. And frankly, it's very hard operationally to predict where an auction is going to go off, given the company's performance, investor interest, what's going on in the markets that day. And so as you can see on the next slide, we really haven't seen a lot of companies pursue this, even though it's a fairly low requirement in terms of who would qualify to leverage this. So what are we doing about this? On slide 31, you can see that we actually now have put in what we call a CDL order to facilitate this. And so what that says is basically it's a limit order. It's gonna price at or above the lowest price or at or below the highest price. And then it can't be modified or canceled once it's been entered. So basically, if the company's going to go raise money in the auction, you have to put that order in. And then if the auction starts indicating outside of that range, well, then at some point you have to decide, okay, I guess we have to stop, refile, consider a new range. On 32, what you can see is we actually have a new rule that we've proposed here at NASDAQ to modify the price range limitation. And so it's got basically two parts. One says, let's give companies a wider range, 20% below or 20% above the stated range. Or if the company can certify to NASDAQ that the price would not materially change the previous disclosures. So basically, hey, we haven't said anything in our registration statement that would contradict this. Then it would allow the stock to open 20% below the range or any price above the marketed range. And so then you'd actually get this true price discovery, which is kind of, again, the hallmark of a direct listing. You'd want to see the ability to do that. And so I think that's now working through the rulemaking process at the SEC. As you see, they did issue an order to kind of move the process forward on September 24th. And the SEC is still soliciting comments for this. So if this is something you'd be interested in learning about more, or potentially putting forward a comment letter to the SEC, that's something you'd be encouraged to do. It's one of the hallmarks of the exchange listing rulemaking process is we do look for public comments for interested parties in the capital markets to share their views with the SEC, so that it's not just us at the exchange kind of writing the rules in the absence of market feedback. But if, for example, there's companies out there that feel strongly that this should be part of the rules, we'd love to hear about that. And I'll turn it back over to you.
Thanks, Jeff. So there were a number of concerns raised by the SEC and by various shareholder groups when the New York Stock Exchange and NASDAQ put in their amendments to do precisely what Jeff mentioned, which is allow for this concurrent capital raise with a direct listing. So it proved to be quite divisive with the Democratic commissioners, as we point out on the slide, Commissioner Lean, Commissioner Crenshaw at the time dissenting from the approval order, the SEC's approving the NYSE amendment, which preceded the the NASDAQ amendment. And if we go to the next slide, what we see is that among the concerns that were raised really were concerns relating to the fact that if an issuer does go this path that Jeff raised of doing a concurrent capital raise with a direct listing, there's no underwriter involved. So the Democratic commissioners raised concerns about there not potentially being cheaper, and there then not being someone who was a statutory underwriter. And so if you read through the SEC order, there's some language that potentially could be a little problematic, a little troublesome, relating to whether financial advisors might be considered statutory underwriters, depending on the roles and the functions that they undertake. Likewise, there's some language which is very interesting, and we'll see if we have time to get into it, about this whole notion, which may seem a little metaphysical to some of our listeners, about traceability. It's been very much in the news of late because one of the cases that first has challenged, that was actually a challenge brought in connection with a company that went through a direct listing, the Slack case, raised regarding traceability. And the SEC raised traceability as being a judicially created notion. So it kind of punted on this whole topic of traceability and left it as something for the courts to consider, decided essentially not to think about it when it was considering the New York Stock Exchange and NASDAQ's requests, and also pointed out that this topic of traceability and there not being, or it being more challenging to trace where shares come from and whether they come from a particular registration statement occurs in the context of other securities offerings, like at the market offerings and any number of other offerings. So we'll put aside some of the legal metaphysics and welcome Spenser, who has joined us. And Spenser, thanks so much for joining.
Great to be here. Thank you, Anna.
We had a bit of an opportunity with Ashley and Jeff's help to hear about their perspectives and how they help companies think through the advantages of direct listings, a little bit about the market experience of some of the companies that have gone through direct listings, some of the concerns that they worry about in terms of there being liquidity after a company undertakes a direct listing. So I guess first and foremost, maybe you can tell us from Amplitude's perspective, what was the driving force in terms of Amplitude's decision? Why a direct listing? Why was it the right answer for Amplitude?
Yeah, absolutely. And the short is pricing. You can get market-based pricing via direct listing. Whereas with a traditional IPO process, even with some of the modifications, effectively you're setting the price centrally, and so we have this phenomenal tool, where you have an open market and you can have the buyers who are interested in buying come in and the sellers who are interested in selling come in, and then come to a correct price and incorporate all that information in a correct price for the stock of your company. And so, with Amplitude, we opened at $50 a little over a month ago. Whereas if we had gone with a price that we had selected, it likely would have come out around where we did a reference price, which was $35. So we would have underpriced our company by 30% if we had done a traditional IPO. I think if you look at over the last in 2020, the set of IPOs that went out that way, the average underpricing was actually 50% for a company, which is absolutely crazy from my standpoint. And so, for me as a fiduciary to my shareholders, like I have to get them the best result in every fundraising round possible. And a traditional IPO goes against everything, it goes against everything, giving you an accurate price. And so, it ended up being phenomenal. We got a great price for our stock on the opening. Folks were able to transact at the correct price for Amplitude shares. And we were able to achieve, get some really great public market shareholders and achieve all of our objectives in the public listing and more through a direct listing.
So Spenser, a lot of times when companies come to us and they're thinking they're weighing direct listing or not, they look at some of the names of the companies that have done direct listings. And in a sense, they think that the bar has been set where it has to be a company that has like a certain brand name attached to it, right? A certain, a company that has, that's like so well known to the average investor. Was that concerning, or was that a thought process at all? Was that something that was that whole process of like investor education daunting, or did you feel any of that pressure? Was that a factor for the board or for any of the stakeholders?
Yeah, I mean, it definitely it took a little work for me to get the full board comfortable with it. I think I think that's been the conventional wisdom, where you have to have, you got to be a big name brand like Spotify or Slack or one of these other guys. But the reality is, I think you have to separate two things, which is one is public market investors and buyers in your stock from just the general public. You don't need to be a well-known brand with the general public. And I think the traditional IPO process was designed 50 years ago, when there was when one, companies went public a lot earlier, and two, there was a lot less information available. These days we have, there's so much more information, and public market investors are much more sophisticated. So you don't really need bankers to go around offering your stock. We did all the same education of investors, and there was the same awareness around Amplitude as if we had done a traditional listing. And so even though Amplitude, we're a kind of mid-cap stock, and we're not like this massive brand or anything like that. We do a digital optimization for this set of B2B buyers. It didn't matter at all, because there's tons of, we're in SaaS. It's a very well-known, that's a very well-known business model. There are tons of public market investors who have been tracking us for a while. We're able, you're able to do all the same things you do in a traditional IPO process. There's some nuances, like you have to schedule your meetings with public market investors directly, but their interest and knowledge of Amplitude as a stock did not change at all with the direct listing process. They're able to get, theoretically, the idea is the bankers can help sell it for you, but the advantage is basically effectively none. And so in today's day and age, where there's tons more information out there, where companies are going public much later, $1 billion or more in market cap, there's basically no reason to pay this huge premium of hundreds of millions of dollars on your stock in order to, if we had gone a traditional IPO, we probably would have raised $300-400 million. And we would have done that at 30% discount. So we would have easily lost $100 or $150 million on our table. And there's kind of no real upside. As a CEO of a public company, who do I want as my shareholders? I want people who have the most conviction in my company, represented by their willingness to pay for the stock, and not kind of anyone else. So it didn't the idea that, hey, you have to be this big brand is totally not true. There's lots of including us, there's lots of other companies pursuing the direct listing path that, you may not think, Asana did it a little bit before us. There's going to be more companies after us that do the same path. And, if you're a business that's $1 billion in market cap or more, that's not a problem.
I don't want to monopolize Spenser. So Jeff, Ashley, if you have questions, feel free to interject. Spenser, along those lines, just of the investor base, do you feel like a lot of the key institutional investors came in post the direct listing or in the direct listing, or is it difficult to tell?
We had both. I mean, we don't have all the data on who's an investor in Amplitude yet, but we had quite a few. We had 5 or 6 big buyers that came in on our direct listing, and we've had a few more that have come into Amplitude as a stock since then. And so, it's been a mix, but it's been very healthy for us as a company in terms of the amount and diversity of interest in Amplitude as a stock. I think, I think one of the things that I just wanted to comment, one of the other reasons that, people say in defense of traditional IPOs is that you're able to select your investors, but honestly, like, it doesn't matter. Again, I don't, like this idea that you'd rather get someone who's willing to pay a lower price than a higher price. Like, one, it's against my fiduciary obligation to my current shareholders. And like, 2, like, I want someone who has belief in us long-term. And so I've heard of traditional IPOs where bankers will threaten to hold up your IPO if there's not if you don't lower your price so that a certain investor like T. Rowe or whoever else can get in. And that's the craziest thing in the world to me. And, to be clear, we got some of that during the direct listing. Oh, well, your price is too high. It's like, I don't want to be a buyer because your price is too high. It's like, well, that's how markets work. it's like, yeah, like there's a lot of buying interest. So, if you're not, it's like that Yogi Berra quote where it's like, oh, nobody goes there anymore. It's too crowded. It's like, that's how markets work. And so, you're going to get great buyers who have a great belief in your stock if you do a market-based pricing process.
And sir, I'd love to hear your thoughts a little bit on another really important constituency, but your employees. So the Amplitudeers, and how did your employees react to the fact that you were doing a direct listing board versus a traditional IPO? And walk us through a little bit of the thoughts on those kind of internal messaging.
Yeah, I mean, we spent some time. It's something I'm passionate about, so I spent some time explaining the why and what it meant, and they loved it. First, that we're going to get a great price on our stock day one, and then 2, that there's no lockup for Amplitude shares. And so, I think, again, this is one of the relics. This is one of the relics from the traditional IPO process where you have a lockup and people can't sell. But again, that's silly. These days where there's so much information out there and you're able to converge on the correct price for your stock right away from that first trade, and the technology is out there to do it. And so, I think first that they were able to sell at the opening, as part of that first transaction. There weren't any constraints, artificial constraints on that. You could sell all your position, none of your position, somewhere in between. Most folks opted for somewhere in between. So being able to reward particularly folks who have been there for a while right away, and that it's a correct price. I think that's one of the problems with lockups in the traditional process is that you don't really know it's the correct price because the full supply, the market supply is not there. And so, I think the Morgan Stanley, when we worked with them as part of the process, who were Colin in particular over there was phenomenal. He understood what we were trying to do with the direct listing. What they showed us in terms of the data was that actually direct listings have less volatility in your stock, which is a great thing, because that means whether you're a buyer or you're a seller, you're more likely transacting at the correct price for the shares. And so from an employee perspective, they loved it. The other argument, which again, it's so stupid, but I've heard a bunch, is that employees expect a monotonically increasing stock price. And it's like, again, that may be true 50 years ago when there's much less information and much less sophistication around these, but employees are not they're knowledgeable. They're not, they don't expect something that just goes up into the right forever, just like everyone else. And so they understand that, it's much better to get a great price and a correct price than just have this, big day one pop, which indicates you're giving up tons of money as a company. And so I think, one of my learnings has been that there's just not that much information out there, and people are kind of scared to disrupt the status quo. But, we looked at it for quite a bit, came to the conclusion that direct listing was, now that knowing what I know now, you could never force me to take a company through traditional IPO, because I would not be doing my fiduciary duty to my shareholders and getting them the correct price for their shares. So, I think the key thing is the education piece. And so making sure to bring everyone through, okay, here's what we're doing and why, and taking the time. I think that's been one of my things. I think that has been a gap, unfortunately, is education, particularly of employees, where this is a super meaningful part of their compensation, has not been great. So we ended up doing a whole bunch ourselves, but that worked out great, and they were really excited about it.
Spenser, it's Ashley here. Just curious, given your history and how knowledgeable you are about the process, how do you combat the feedback that which we often come up against about the information asymmetry that exists between your VC and individual holders as a private company versus the public investors who are going to invest in you? There's often some reticence from some of the public investors to participate in the direct listing because of that. I'm just curious what you say to those people.
To participate in a direct listing over a traditional IPO?
Over a traditional IPO, yeah.
The same issue is there in a traditional IPO. The what you're supposed to disclose in S1 is no different. It's the exact same set of information. You run the exact same process where you give the pitch to the public market investors. You do your investor day. You do a roadshow. You put the S1 out there, you do the calls with analysts, like the entire process end to end is the same in terms of what you're supposed to disclose. My thing, this is a little provocative, but my thing to public market investors is, I think traditionally the argument has been, hey, we're going to give you the stock at a discounted rate in that initial offering, so that you can get a thing that trades up a bunch, and even if there's information asymmetry, you're good. But honestly, I don't want someone who is looking for a free coupon. I want someone who is willing to bid a bunch, who has a long-term belief in the stock, represented by what they're willing to pay for it. And so our stock has rocketed up like crazy since. We're at high 7. We opened at 50,
you hit a new high, yeah,
70s. And so it's like, which is has its own issues, but it's not, again, it's like in terms of that's just part of the game when you're buyers when you're a buyer versus a seller, and that issue is present whether you're doing a traditional IPO or direct listing. It's not, you don't get some advantage. In fact, direct listing is way better, because if you are willing to outbid everyone else, and if you have more long-term belief in the stock, you can get filled completely. I was talking to some hedge fund that was able to get an allocation Amplitude because they were believers in our company. And they were telling us that if we had done a traditional IPO, their allocation would have been $500K worth of stock. And it's like, well, why 500? And it's like, well, 500K, for public market investors is nothing. It's like not, it's not enough to move the needle. And, I was asking them, okay, why would you get such a small allocation? It's like, well, we're not, don't have as good of a relationship with the bank yet, and they're the ones allocating it. And it's again, to be a little provocative, it's like this crazy thing where it's like, okay, it's like, we have a open market, and exchanges have a process, price time matching process. It's like, let's use that instead of like pretending we're some central planning committee, in a communist country that's allocating, scarce goods and services. It's the craziest thing in the world. So I like, again, the fact that there's a open market allocation process should actually give you a lot more conviction that you're getting a correct price, because again, all the information is incorporated into that price as opposed to, picked out of the air by bankers or me or whoever else.
Now, Spenser,
So-
Amplitude helps really big brands, digitally transform and drive their marketing plans. A big part of going public is marketing and brand building. So we talked a little bit before you joined about the concept. Do you feel like you lose anything in terms of the brand building going direct listing versus the IPO, or do you think the experience and kind of the process of going public through direct listing gets you all?
Yeah, absolutely. We were able to accomplish all we want here. I'll share with you guys. I'm going to share my screen for just 2 seconds to show you. This is a snapshot of some of the coverage. We were able to get everything we wanted to do accomplished and more in terms of press coverage. The funny thing was we set the reference price, which kind of is made up. It doesn't really have any impact, but allows you to say, hey, we jumped a lot versus the reference price. And so we got all the great press saying, hey, we're a hot stock and we're high flying and this, that, and the other thing on our, on the listing day through doing a direct listing. So again, that's another constituency where, press is more sophisticated these days. They're also not expecting a monotonically increasing stock price. You don't need to coddle them. You're able to do what you want. And so I think the problem with the press is actually a different one, where there's so many public listings these days that it's harder to break through it. So, but yeah, again, whether you do a traditional IPO or direct listing, that's not a guarantee either. And so, direct listing has had, from my standpoint, zero. So it had no negative impact in terms of, we still got a bunch of coverage saying that our stock had jumped like crazy. And then two, the fact that we were doing direct listing, frankly, was more newsworthy because there's only so many to do. So again, for those CEOs and CFOs in the audience that are considering their path, it's like, if you're looking at it from press angle, do the more newsworthy one sooner rather than later, before everyone does direct listings, which, I hope everyone does direct listings in the next few years, but we'll see how that turns out.
I guess maybe the last question, and Jeff, I don't know if you want to discuss this a little bit as well. Just, had there been a possibility to raise capital with a direct listing, Spenser? Would that have been something you would have chosen?
Yeah, absolutely. Yeah, we did want to. We had to do a reference round, a few months beforehand, back in May, before a September listing. So ideally, we wouldn't have done that reference round. We would have been able to just file primary. Unfortunately, I think there were two issues with it. One, the current technology out there, I can't remember if it's NYSE or NASDAQ, but one of them allows it. But you still have to be within some 20% range of something you set. Like the price can't be like outside of some range, which to us defeated a little bit of the purpose of doing a direct listing. Like the point of a direct listing is like, we didn't know where the stock, we thought the stock was going to be a good deal lower before we went out, and there was sufficient demand to make it very, very high. And so it didn't matter. Like so ideally we would have done a primary raise instead of having to do one earlier. The other problem is because someone needs to do it first, because the SEC, there's a new thing for the SEC, and whenever you're doing something for the first time, it's going to take a lot longer. So it probably would have added 6 months to our process. And so, we wanted to get out sooner rather than later, like most companies going through the public listing process. Someone needs to be the Spotify that's willing to spend, an extra 6 months or a year in their public listing process to do it right, to get the primary raise, and then it'll be faster for everyone else. And so, yeah, that's something that, if you have a little bit more time, I'd strongly encourage you to take a look at. It's definitely, it's a little bit too much risk from our standpoint, just because it was new process and you still have to set a range and all this other stuff. I think that I'm really excited for the day when that comes out, because, again, then there's basically no reason to do a traditional IPO. You don't have to do the reference round. You can get a great price for those shares as well, and everything else.
Yeah, Spenser, we covered a little bit before you hopped on. We do have a proposed rule out there that would uncap the top of that.
Okay, great. Yeah.
Still
Yeah.
working through the SEC process on that, but
cool. Yeah. I mean, I wish we had, if we were a little bit, for some of the folks in the audience, as you guys are considering it, that, that's definitely something I'd take a close look at, because ideally we would have done it too. It just was like, the technology wasn't quite there yet. So.
Well, since we're almost at the top of the hour, I'm just going to ask Jeff, Ashley, if they have any last words or predictions on what's to come in terms of direct listings, and I guess what we have left of the year, or maybe for beginning of next year.
I think all I'd say is echoing Spencer. I think it's a product that's here to stay. Again, I continue to reiterate, I think it's still in innovating and in its teenage years as becoming a product that becomes a little bit more mainstream used. I do think that we will see a lot more direct listings. There's probably an equal amount lining up for next year as that we saw this year, and much more in years out. So it's obviously something that everyone should consider as they think about the going public process.
Yeah, and I would just say, as you kind of consider the different reasons why you go public, obviously for a long time it has been about raising capital. We see a very robust private capital market right now, so that obviously means capital is available to a lot of private companies. When you think about liquidity, obviously a direct listing is going to have much greater liquidity earlier in your life as a public company, and then of course, as we talked about, kind of building your brand and establishing your company as a major player. That's obviously something that NASDAQ will help invest in and help you grow your brand over time as a NASDAQ listed company. So I continue to think we'll continue to see companies take the best path for them, and a lot of it will just be driven by that supply of capital on the private capital side.
Great. Well, thank you. And I want to thank Ashley, Jeff again. And thank you very much to Spencer for sharing his very candid thoughts with us on Amplitude's experience. And thanks to all of you for joining us. We appreciate it.